Contrary to the narrative that's circulating on Wall Street and in social media, market is setting itself up for a big plunge. And while nobody has been paying attention, I've been calling out this information for the last month. Now, after all of this work, after all of this time waiting, it's time to watch the big crash happen in front of our eyes. Eyes. Hello, everybody. My name's Drew Demon, and I am the Devil Stockbroker. In this video, I'm going to be covering the broader market and the SPY. We're going to be tracking what's currently going on the tech sector as well as the main finance sector and discuss some of the ongoing news that's been hitting the market this past week. It's been a really busy week for news and a lot of busy, there's been a lot of work for the banks. First, let's go over to the stock market heat map and take a look at where we ended today. So, yesterday, we had a giant pump in the market. There was this big expectation that there was going to be a huge surge of liquidity and a massive recovery coming for all of the financial sectors, all of the banks that have been in trouble. And this was misread by basically everybody that was talking on social media and also by the mainstream news media that this was some kind of a pivot by the Fed. This narrative could not be any more wrong. This was an emergency measure by the Fed in order to push the banks and give them enough liquidity to protect their depositors in order to prevent runs on the banks. Historically, whenever this kind of a panic occurs in the financial sector and average people in mass run to the bank to pull out their money and pull out their deposits, it drains the banks of their vault money. This is because we work on a fractional banking system, fractional reserve system. A fractional reserve system means that a bank only has to hold a certain fraction of its total cash reserves for its depositors. So, a bank that has more than something like $100 million for its depositors, they may only need to hold maybe 5 million, maybe as little as $1 million cash in the vault at any one time. Now, this is a really this is a really broken system in situations where we've had massive defaults happening at the same time. This was proven in the bank runs that crippled the economy back in 1929 and caused a whole bunch of banks to fail overnight. The panic on Wall Street and the Black Tuesday uh, defaults of all of the banks back in 1929 led to the greatest depression that any world economy has ever seen. It particularly hit the United States the hardest because the United States had climbed the farthest. A world that was crippled by a pandemic and a massive world war, the First World War back in the 1910s, crippled the European economy and left America as the center, the economic center of the world. And because of that, it sent us into the roaring 20s, famously leading to a period of massive excess where everybody had access to everything, luxuries like we had never seen before. And eventually, that caused rampant inflation as well as a big surge in spending by the consumer that was ultimately unsustainable. It was also marked by access by retail investors, one of the first times in history where average individuals were able to invest in mass into the market. So, widespread access to a stock market, overly bullish sentiment, and no past or prior history that anybody could draw experience from to determine whether whether this was actually good for the economy set America up for one of the greatest financial disasters of its time. In fact, the greatest disaster of its time. We have the benefit of history to look back on and tell us what is actually going on now in the market. So, for that purpose, I'm going to take you back in time to the SPX, back when we were trading in 1929. This is a weekly chart for the SPX. This is the Standard & Poor's 500 index that's been around for more than 100 years. And this was present when the great financial meltdown occurred that led to the Great Depression starting in October of 1929. This massive panic occurred as a result of banks losing liquidity. Black Tuesday uh, of October 1929 is what marked this great financial crash. The massive capitulation that occurred over the course of those next 2 weeks left so many individual entities, banks, institutions, and individuals completely broke that it washed out all the money out of the financial system in just 1 month. And this, uh, it did recover slightly, but it wasn't sufficient in order to restore any kind of confidence to the market. Now, this was a catastrophic failure in the financial system. We didn't have the benefit of history where the Financial Reserve Bank or the Federal Reserve Bank, the central bank of the United States, was able to see this coming. This was the first time that something like this had happened. Now, what would have saved these banks is the ability to be able to push a massive amount of cash into the banks in order to prevent them from going insolvent and leading to a massive loss. The problem with this system back then was everything was all paper records. We don't have that anymore. We have electronic record keeping, and we also have the ability to do instantaneous electronic transfer so that we can push funds very quickly. We still have to move physical cash, but the ability for banks to deal with each other electronically and order in almost instantly to have cash deposits put in their vault gives us a lot more flexibility. And this is what the Fed is doing in order to protect the banks from total collapse. Now, this is not bullish. There's nothing bullish about this situation. This is, in fact, one of the most terrifying financial situations that America can go through, any nation can go through. Because right now we're dealing with rampant inflation, which is already a massive problem for the entire globe, but especially the US dollar. We have massive supply chain issues. We've had catastrophic losses of our ability to move goods and services around the United States. All of this is happening all at the same time. Surging fuel prices, the cost of electricity and energy generation is going up. All of these are making everything much more expensive. And when you put that into perspective and realize that the banks are now in a situation where they are running out of cash, and people are so scared of what they have to do, and in order to survive, people are pulling their life savings out of the banks rapidly. Combine that with high interest rates, and some banks are not able to sustain that kind of volatility, moving cash in and out of their vaults. So this has really led to an extremely dangerous situation where currently everybody is wondering what's going to be the next bank to fail or go insolvent. It's very likely that the Fed will continue to put cash deposits in these banks in order to protect the depositors. But everybody keeps talking about it like it's a bailout. It's not a bailout. The definition of a bailout is the Federal Reserve, by vote of Congress, to print enough money and give it to the banks in order to make them whole and pay for all of their bad bets in order to make sure that the bank's assets are whole and survive. That is a bailout. When the bank loses hundreds of millions of dollars in bad financing and terrible debt that completely goes into default, that's a bailout. This situation right now isn't even remotely close. This situation is caused by everybody pulling their money out of the banks at the same time, and the banks can't move assets fast enough to give their customers their cash. That is the real situation. Now, depositors are entitled to receive their money. What's causing so much alarm for everybody right now is that we've already seen two major banks fail completely and lose all their liquidity. And this has historically always led to a massive contagion effect where everybody says, oh God, now there's banks failing. I need to get my money out of the bank. And then they subsequently cause more banks to fail by doing this. This is the kind of contagion behavior that can lead to major economic crises. The Fed is stepping in now in order to prevent that from happening, but that is not a bullish signal, okay? That is not bullish in any way. That is the Fed making an emergency executive decision in order to back up the banks, in order to prevent them from completely collapsing all at the same time. There is no bailout happening. The only people being bailed out right now are the depositors who are pulling their money out of their life savings account, and they're being incentivized to keep it there. The Fed is trying to hold on to the public faith in the US banking system in order to prevent it from being wiped out. And personally, I don't think that we are in a position where the banks are all going to get wiped out at the same time just yet. I don't think that we're there yet. But when you see all these depositors pulling their money out at the same time, this creates a really uncomfortable situation for these banks where they now need to decide whether they need to start bolstering their cash deposits and exiting out of positions in the markets. That means that they're going to start doing drastic things in order to protect themselves, in order to ensure that they are very cash flush. That includes selling equities, bonds, and convertible tranches of different types of derivative instruments. It can be all kinds of different things, metals, forex, whatever, you name it. Anything that they have that is particularly risky, that they cannot afford to hold on to through the tumultuousness of this ongoing market, they are going to start getting rid of that and unloading those positions in order to ensure that they have a high cash position. And they are going to start trying to ensure that they are keeping their money markets flush with cash. Reason why they do this is because it's a safer asset and they can always pull it out in cash equivalent positions quickly in order to ensure their depositors get their money. Now, what is happening here is the Fed is buying the banks time to do this. They have given them cash in order to keep them solvent and satisfy their depositors with enough money until the banks can adequately withdraw from those positions. This is going to take time. This is going to lead to mistakes happening in the market. Banks that get into a this is well, I should be careful. I want to be very clear. The Fed is giving them cash so that the banks do not have to rush because rushing leads to mistakes. The whole panic that occurred in 2007 and 2008 with the subprime crisis led to the massive crash because the banks had to hastily exit their positions once they suddenly realized that they were going worthless because the instruments were not well understood and there was not proper regulation being done and oversight of the banks and what they were doing. Things are a little bit different now. The Fed is going to force the banks to start liquidating positions because the regulators are staring them down, watching their operations, and seeing that they're going to start analyzing their balance sheets. If things don't start adding up, or if things start looking sketchy, they will do what they have to in order to force the banks to comply. Now, let's get into the technicals of what's actually happening in the market because what we're seeing here on the technical charts is also just as bearish. For starters, let's take a look at the 1 week chart, okay? From here to the bottom, we have seen that the market has established some really good support on the SPX, the Standard & Poor's 500, at 3,500, or if you're on the SPY, 350. Now, this marks a floor in the market where we have had some really solid support. However, what we currently have right now is we have been setting up a bear pennant ever since September. So this setup, as it currently stands, is an extremely bearish setup. If I drop down here to the daily chart on the S&P, there's a couple of different areas in this chart where I see continuous trends to the downside and different rejection that occurs. One of the common resistances that we have seen repeatedly was $4,200 on the SPX or 420 on the SPY. This level has been consistently resisted or consistently rejected price action over and over. The only time that we broke it was when Apple was pushing the entire market up by itself all the way up until August 16th. And then we had all of the scares going on with the liquidity of the UK banks, as well as the gilt market, which is the UK's bond market. Their pension funds started to go insolvent and started losing their cash because all of those gilts in the 10-year gilt market were going worthless quickly. Their central bank had to, once again, step in an emergency and provided those pension funds with the necessary liquidity to exit. Basically, what they did was they set a max price and said, we will buy these bonds off of the pension funds at any price. We will match any price they need in order to ensure that they can get out of those positions and meet the pensioners' needs and keep the pensioners safe. This is something that's unprecedented in the market that I don't know of any other time in history where this has happened, but that's what the UK central bank, the Bank of England, did in order to protect those pensioners, people who, rely on that for their retirement. And this was to prevent panic from all of those losses and to prevent people from being, put out of retirement because of just because of a fluke in the market, a big panic in the bond market. We're starting to see this kind of activity happening now, but as far as the technicals go, we can see that the market already rejected this 4200 level, and there's another level right here where we seem to keep bouncing off of and then getting rejected, and it was right here at 4,000. 4,000, give or take about 50 on the SPX, or about $5 on the SPY, up to 405. This is a level that we rejected off of, and we just rejected it again. Now we've seen the market attempted yesterday to break out back into this bear flag that was being formed by the SPY. We didn't break it. We wicked through it, and then we closed just outside, and now we are rejecting again. Now I'm going to take you over to the SPY and the HYG. This is a ratio chart that looks at the SPY, the stock market, versus the bond market in high yield grade bonds. These are junk bonds, and this is what we look at for when institutions are bidding up the market. If the market is being bid up and everybody is in agreement as far as institutions go, then the HYG will go up, and usually SPY goes up with it. When the HYG and SPY disagree with each other, usually the bond traders, the HYG traders, are correct, because these are the big institutions. They have the most money, they have the most pull in the market, they have the most liquidity. Usually, if we are seeing the SPY surging and we are not watching the HYG match that move, then that tells us that we are seeing a big rejection in the market. One of the ways that I track this is by watching to see if the HYG breaks its previous resistance and turn it into support. That didn't happen. That actually got rejected yesterday. Now today we have created an inside candle, or a Harami doji candle. This is a very bearish signal. What it suggests is a lack of confidence by bond traders. So what this means is that the bond traders are not in agreement about the price of the market. They are not bidding up the junk bonds. If they're not bidding up junk bonds, they're not confident in the companies that are trading on the SPY. That's what most of this is made up of, is junk bonds in the stock market for corporate bonds. Now, because they are not confident, they are not bidding this up, that's going to lead to weakness in the SPY. Right now, we see that the SPY matched this candle with an inside Harami candle. And if you look at this, just by looking at this chart, you can see that the SPY is creating a bear flag again, and so did the HYG. So anybody that is trying to claim that this is a bear trap, and there's been plenty of people that are trying to convince me that I'm running into a bear trap and that I'm some kind of an idiot because I'm not bidding up the market while we're going through a massive banking crisis and insolvency scare. I think that you're crazy if you are buying into this market right now while the entire banking system is being held up by toothpicks by the Fed in an emergency funding action just to keep the market from completely collapsing. Because I don't know if you noticed, but there were banks left and right that were losing 60, 70, 80% of their stock equity value in a single fucking week. If you think that things are safe right now and you think that the market is strong, you are nuts. You are absolutely out of your goddamn mind. And I'm sorry to be so blunt about this, but this is not bullish. I don't know why anybody would be telling anyone to go and buy and bid up the market right now in a time when we have massive inflation. We have the Fed that's barely holding it together. Interest rates are skyrocketing. The housing market is crashing. And the bond traders are looking at this like, look at how crazy the bond market is right now. It's down 5 and 7%. The yields are collapsing. The 2-year bond is down by 7% today in a single fucking day. Are you kidding me? So I don't know I don't know exactly what's going to happen in the market, but I feel like it's really irresponsible to tell people to just go buy calls and everything and then just ride the wave up because this is the recovery. I don't know any time in the history of anything where the banks started to collapse, where suddenly the market went ripping into the stratosphere. Anybody that is telling you this is selling you a giant bucket of horse. So I want to really, really warn people to be extremely careful of what is happening and be very skeptical of what people are telling you. And please don't take my word for it. Please do your own research about what these indicators mean. Look at the historical factors that have happened since 1929. Look at the situation that we were in the roaring 20s when everything was going up and up and up forever. And then suddenly we crashed by 90%. The market completely collapsed. And it happened really fast then because, we didn't have the history of how to handle the situation. Now the Fed is trying to slow everything down. They're a little bit smarter, a little wiser with access to better analytics tools and more timely information about where the economy is at. But they didn't have that back then. So maybe they can slow down things from collapsing and maybe make it a little bit less awful than it was back then. But it doesn't mean that it's going to be comfortable for us. It doesn't mean that it's going to be great. I highly doubt it. The other signal that I have here is that every single time that we've had this MACD cross down from the top, there's been at least one attempt to break a crossover to the upside in the market, and we have tried to do it twice now in this last move. We tried here, and then it failed, and the market started dropping again. Now it's trying one more time to cross over, and I think it's just going to end up rejecting again. Until you get that MACD crossover, usually two crossovers, it takes two crossovers from the bottom before the spy actually recovers. Notice two crossovers on the bottom, and then the spy went into a bull trend. Two crossovers down here, spy went into a bull trend. And keep in mind, this is based off of the HYG and SPY ratio chart. This is an extremely effective indicator for swinging the market. And I strongly recommend it to people to learn this and look at this chart and analyze it. This is extremely useful. If you have TradingView and if you want to get access to TradingView, check out the link in the description of this video. SPY/HYG is all you got to type to get this exact chart, and then you can add the HYG onto this just like I have, and then the SPY right below it. And then analyze it, compare it. Look at these signals. The MACD signal on SPY and HYG is super effective for timing the top. Look at the crossovers. Crossover at the top, we went into a downtrend. Crossover at the top, downtrend. Crossover at the top, downtrend. It's super effective. Just learn how to do this yourself, okay? That's the point that I'm driving here. Okay, so a couple more things before I close out the video. The other thing that people have been really pointing to, besides bond markets, besides the HYG and SPY, the Dixie. This is the dollar index. Right now, the dollar index is down, and it's been looking really negative for the last couple of days. Here's the thing. The dollar index moving down with the SPY today is actually very, very unusual. Normally, the dollar index and the stock market are directly opposed to each other. This is pointing to a weakening dollar where we're witnessing the banks receiving a fresh boatload of cash from the Fed as an emergency measure. This is going to lead to inflation because the Fed is probably not going to get that money back, and it's going to remain floating in the system now until the banks can figure out what they're going to do. But at some point, this is going to lead to some inflation. Now, the question is, will the dollar index break this cup and handle that I have been watching happen? It's been forming for a while. We've been here in this pattern for some time, and we have bounced off of this support level now with a morning star candle here down on the 14th. That was this Tuesday. So will we get the bounce and will we see the dollar rip? Quite possibly. I'm actually kind of expecting it. Here's the thing. That is usually when the market completely collapses, because right now people are looking at the market very skeptically. The reason why this happens is because when the dollar index is up and ripping the forex market for the dollar, which is basically just means the dollar is getting stronger or more valuable than the other currencies, the other six top currencies in the market. Usually this creates a desire by institutions to move their money out of equity into the dollar because it creates a more stable growth. And right now, Banks are going to need some cash. Banks are going to be looking to move into cash at an ideal moment. So if they move into cash soon, when the dollar is currently down, then they will have the best opportunity to ride it to the upside and create some additional liquidity for themselves in order to move it into other assets, or at the very least, to dodge the downside that will be coming for the market shortly thereafter. We're getting set up for another crossover on the MACD. We failed the last one and we've been creating lower peaks on the dollar index, but it's been wanting to break out for some time. We've been consolidating in this area for a while. This range has been sitting here for quite some time. We've already clearly bounced off of this level. I'm expecting that now that we have tested this support once already, we only need to test it one more time before the dollar starts to go back to the upside. And that is more than likely going to cause a drop in the stock market. It will cause a drop in equity value. Other thing to point out is that the housing market is not doing well. XLRE index is down, and it's been continuously moving down, even as the quote bullish move in the market yesterday was carrying all of the other stocks up. My DRV positions have been doing extraordinarily well, inversing this index, and basically going short on XLRE right now looks like the right move. We currently have this head and shoulders pattern that has kind of started to develop. Um, it's a big question if we're going to see a shoulder actually form out and then break this neckline, but we don't necessarily have to do that because, frankly, we tried doing that this in the last move that the market did, and it just cut straight through it. It didn't even bother forming another shoulder. It kind of like created a slanty head and shoulder and then just gave up the ghost. So things aren't really looking good for the housing market either, and we're seeing all of that value in home equity starting to drop. There's a lot of houses that have lost 40% of their equity value in the boom towns already. So this is also going to create a lot of pressure in the market. And one of the biggest reasons why the banks are having such a problem with cash liquidity right now is because the banks that had a whole bunch of their money in mortgage-backed securities, a lot of those mortgage-backed securities got washed out recently. The value of those mortgage-backed securities is starting to evaporate. You can actually corroborate this with what's happening in the VMBS, or the Vanguard Mortgage-Backed Security ETF. It dropped out massively over the last few days. It's been kind of bouncing around since the mortgage-backed securities market has been bouncing around since the 8th of March, and it kind of recovered a little bit. But we saw that one of the biggest problems with what was it, Silicon Valley Bank, one of their biggest ticket items on their balance sheet was actually tied to mortgage-backed securities, and we're seeing equity from companies like BlackRock and Blackstone starting to lose their value as well. So if mortgage-backed securities don't suddenly have this big surge of value out of nowhere, then we might see this head and shoulders in the backed securities market cause another drop in it. If it's anything like it was on par with 2022, then I'd be very scared for the banks, because this is where they love to park their money for quote risky assets. Mortgage-backed securities are one of the best returning instruments in the market. They're very expensive, but it is exactly where the banks like to deal their money. And if mortgage-backed securities start losing value again like they did back in 2022, then man, we're in for a really rough ride for the rest of 2023. That's going to be it for this video. I'm all out of time, but thank you guys so much for watching, and I look forward to seeing you in the next one. Until then, have a hell of a time in the markets.